Hello everybody, this is Patrick MontesDeOca, CEO of the Equity Management Academy and leader in Ticket Talker. On this segment, what I would like to do is to review the 360-day cycle starting September 28, 2020 to the calendar year September 28, 2021. And we're going to take a look at how this 360-day cycle integrates itself into the 9-year cycle in terms of the harmonic relationship of these long-term cycles. We're going to take a look at the fundamentals of the market as it relates to the current situation in a report that I published in the Associated Press and Seeking Alpha called "The Highway to Inflation is Open." Summary. We are looking at a pretty dark winter in terms of any kind of economic activity. One of the reasons we focus on the gold is that gold is going to be a major beneficiary of the situation. Governments are printing endless amounts of debt in terms of US dollars, thereby reducing the value of each dollar. This is a generational crisis, but it is also a generational opportunity. Fundamentals. We are looking at a pretty dark winter in terms of any kind of economic activity. Curfews are starting in California. New York schools are closed. It feels again like the first time in March when we first met and we first got hit by the pandemic. The markets reacted tremendously, dropping more than 1,000 points. The fundamentals appear to mirror the sentiment that we had in March, with the difference that this is the second wave. As we move into the wintertime, this can only be and get more complicated. How do you take advantage of this situation? One of the reasons why we focus on gold is that gold is going to be a major beneficiary of the situation. Gold collapsed in March related to the tremendous sell-offs in equities, which also affected precious metals. It was liquidated to raise cash to retain positions. Usually when there is a large sell-off in equities, investors often liquidate precious metals to meet margin requirement for stocks. In March, we saw the first impact of the pandemic economically. Gold fell more than $600 an ounce. At the top, the market got too rich, too fast. It was a historically rally to new highs. The paradigm then changed with gold becoming a currency. In 1971, the paradigm shifted when the dollar was taken off the gold standard. In 2020, it shifted again. The US dollar is a paper fiat currency with no real backing to protect its intrinsic and purchasing power. Gold has value and is now a currency of sorts. Governments are printing endless amount of debt in terms of US dollars, thereby reducing the value of each dollar. The US dollar has fallen about 98% compared to gold since 1971 and is continuing to fall. This is a generational crisis, but it is also a generational opportunity. The economic system is going to have to change. In January, we have the Davos Economic Summit with all of the elite. They were responsible for the 1971 decision to eliminate the gold standard. The dollar then became the petrodollar, more tied to the price of oil than to gold. Right now we are facing mountains of debt. We have doubled our debt since 2008. Banks have $2 quadrillion in risk in derivatives. They have not and did not reduce the risk of leveraging, but have continued to increase their leveraging since 1970s. The volatility in the market is so great now that no trader can handle it. You need to use artificial intelligence and algorithms to help take your emotions out of trading. With help, you can embrace this historic opportunity to make tremendous profits. It is difficult to sort out real news from propaganda. One way to cut through the noise is to listen to what the market is telling us. The stock market continues to rise to the benefit of the wealthy, such as those who can borrow money at almost zero interest rates and then buy stocks and make a profit with almost no risk. Big corporations can buy their own stock and literally make free money. The government is not only supplying free money to play with, but is also guaranteeing the other side of the market by saying they would be a buyer of last resort. No matter what happens, the governments will buy you out. The US can do that because the government can print as much money as they want to print. They are leveraging the asset base of the United States, which means it is coming out of all of our pockets. Someone will have to repay all of the debt, and it will be the taxpayers and all Americans for generations to come. What they don't say is that the more stimulus they provide, the greater the risk of inflation and even hyperinflation. Check out shadowstats.com for the real inflation rate, which is above 2%. You are beginning to see in gold the realization that all of the stimulus money is going to come back to haunt the dollar in terms of its purchasing power and inflation. It will no longer be the world's only reserve currency. Globally, debt only increases, and we are moving into an even more debt-laden economic system. Interest rates have to be kept near at zero for a long time, or the entire system will collapse under the weight of debt payments. Even a slight increase in interest rates will lead to a tsunami of debt defaults. All of this is leading to an economic climate that is going to be highly inflationary. Gold will benefit from such a climate. So, we strongly recommend that at least 1/3 of your assets should be in gold and silver. In the short term, the Fed and the Treasury appear to be preparing for another bazooka of stimulus to hit the market. The gold market appears to be anticipating more stimulus hitting the market. What I would like to do as a continuation of this report is to analyze the VCPMI 360-day cycle as well as the 9-year cycle for the gold market. On the left, you see the 360-day cycle has identified the average price of 1810. In the market, by crossing above that level, as of March 23rd, it activated a 360-day cycle that projected basically the average price of 1810 as the initial target, with the extreme above the 360-day average of 2164 to 2442. When the market activated a buy trigger back in March, it also activated the target of the mean of 1810, which was completed as of April 14, with a high of 1789. Not quite reaching the 1810 average price, and finding basically lower highs or a lower level of resistance had come into the market. And what we saw was a reversion basically from that level very close to the mean, reverting back down to almost the 9-year average that you see here of 1675. The 360-day cycle is in an uptrend, and it completed the target of 1810 as of June 24th, as you see here. When the algorithm completes the pattern, particularly into the average price, it goes neutral. And it tells you, as a self-directed individual, to wait for the highest probability trade next, and that is when the market trades above on a close, or if it closes above that average price, or if it closes below that average price. By trading above the average price of the 360-day cycle, the market activated the sell one level of 2164 of the 360-day cycle as the next target. And what we see here is the market unfolded the momentum towards the objective, and we were able to get to a high of 2099, not quite meeting the target of 2164. But into that territory that the AI identifies the area as an extreme high probability area where you can potentially begin to see selling or supply come into the market. As you can see here, the market validated that by making a high of 2099 and began to revert back. Or we began to see a lot of supply or sellers come into the market. The market reverting back towards the mean, once again, if we use the 360-day pattern, began to consolidate between the sell one level and the average price since April. Not quite coming down to that 1810 level to reactivate that pattern, but we made a low so far of 1854. The protective level of the 360-day cycle is a close below 1810. And the program of the 360-day cycle is projecting a rally into 2164 to 2244 as the completion of this pattern. If we close below, if we fail to get through the upside and follow through to the upside, and we close below 1810, this is going to negate this trend pattern, this bullishness, to neutral. And if we close below 1810, it automatically activates the levels below, which begin to integrate the 9-year cycle. As you can see on this chart, we have identified the 9-year cycle to be at 1675. The buy one level of the 9-year cycle is 2162. I'm sorry, 1262. The buy two level of the 9-year cycle is all the way down to 638. As we take a look at the current pattern, since we are in a bullish trend momentum, the only time that this signal will be activated is if it closes below 1675. Or if it closes below 1810, it would negate the bullish trend momentum of the 360-day cycle. As we look at the upside of the market, or as we look at the targets of the extreme above of the 9-year cycle, we're looking at a target of 2299 to 2712. One of the important things that I want to point out here is that when you identify the VCPMI structure within a daily, weekly, monthly, yearly, or 9-year cycle, you pretty much identify where the probability levels are at the highest levels mathematically within the extreme of the supply and demand of that structure. In using the annual cycle here, it appears that the market is building what appears to be a consolidation area above the 360-day average price, with what appears to be is a descending wedge formation. We're looking at the upper end of the descending wedge, which stopped the rally on November the 9th. And this is the day actually that was announced that the vaccines, I believe it was the initial vaccine that was validated to be about 94.5% accurate. And so that came in here, given the market supply, that essentially broke the market all the way down into this level where we are right now, which is into the mid 1850, 1860, 70 area. Now, if you take a look at the level of support trend line of the descending wedge, it almost comes down right into the yearly average of 1810. And so what I would say to you as a trader and how I'm looking at this information as we come into next week and next month actually, is to buy into these corrections. If you get the opportunity for the market, the gold market, to drop down $30, $40 into this area, you're beginning to build a very high probability area mathematically that we could see a reversion unfold from these levels. And as you can see, these levels also begin to integrate themselves in price as it relates to the 9-year cycle. So a correction in the gold market, regardless of what rhetoric news is out there, if we do see a correction again into this 1810, 1820 area, expect to see buyers come into the market. And if we are able to revert and close above, particularly the high that we made last week of 1973, then it looks like we are pretty much breaking out of this pattern and puts into the picture basically the previous target of 2099 as the next target. And this fits into the 360-day VCPMI pattern that has been identified basically with the first target of 2164. Let's leave this for now and see as we come into next week and as we begin next month what the market is telling us based on the action that we have next week. I will continue to publish this podcasts on a weekly basis here for the benefit of my subscribers, for the benefit of those self-directed traders that are looking for an alternative way to trade the market that essentially eliminates the emotion out of your trading by using the VCPMI as a GPS. It gives you a great advantage of trading the market from a mathematical point of view, not an emotional point of view. Please join me every morning at 7 a.m. Pacific Standard Time in Ticket Talker, where I do a 1-hour live show where I show you basically in live trading in a real account, in real time, live streaming, how I execute this information. In the meantime, my friends, take care of each other, have a great weekend, and I'll talk to you soon.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our Variable Changing Price Momentum Indicator, VCPMI, is an automated AI trading system developed and tested over a decade. The VCPMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VCPMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VCPMI algorithm. The VCPMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VCPMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VCPMI? The VCPMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VCPMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VCPMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit ema2trade.com for more details.